There are very few regulations needed. The ones which actually have some validity are those which prevent big corporations from becoming a single entity with government, and they're constantly being repealed or toned down. Financial markets must be at their absolute most risky in order to attain maximum profits. But don't worry, this time is different. You came here for the truth, so let me unveil that for you. Today, I have some very important information to discuss with you because the stage is being set for the financial crisis part 2. Let's begin. This is a very long article. I'm just going to cover a few select points from it. Let's begin. In mid-January, Citigroup executives held a conference call with reporters about their earnings. Now, it changed into a discussion about S2155. This congressional bill was pitched by its bipartisan supporters mainly as a vehicle to deliver regulatory relief to community banks, and 10 years after the financial crisis, they needed to make some technical fixes to the landmark Wall Street reform law, Dodd-Frank. So you know that thing that was put into place to make sure that the financial crisis part 2 didn't happen? Right. Well, they're trying to repeal that. They're trying to make sure that Dodd-Frank doesn't exist. Well, I have a very bad feeling about that. Well, Citi's CFO told the trade reporters that he thought some of the bigger banks, like say Citigroup, should get taken care of in the bill as well. He wanted Congress to loosen the rules around how the bank could go about lending and investing. The specific mechanism to do that was to fiddle with what's known as the supplementary leverage ratio, or the SLR. That's a key capital requirement for the nation's largest bank. These banks need to abide by certain rules, and already they are stretched so far it is unimaginable how small the reserves need to be. It's talking here about the simple ratio setting how much equity banks must carry compared to their total assets, like loans. Well, that right there, when you understand what's happening with all of the fractional reserve banking, you know that it's extremely small. There is essentially no equity in these banks, and they want to reduce it even further. If you look back into the pages of history, many people refuse to, but you will see every time there is a crisis leading up into it, they always relax the lending standards. That's happening in China, it's happening in the US, and it's happening everywhere else. Now, they've been tightening interest rates, but it's so fractional. And of course, history teaches us that they are always too late and too slow. So looking further into this article, there's some very interesting points in this top paragraph. Well, Citi has been pressing lawmakers to loosen the language even further, ensuring that they can take advantage of reduced leverage and ramp up risk. They're saying that. In the introduction, I talked about how they have to maximize how much risk that they are putting into this system. And of course, that's their own policy. It says it right here. Citi is making a very aggressive effort. And look at this. Who's this quote by? Well, one bank lobbyist who asked not to be named because he's working on the bill. Think about that. The lobbyists, the banking industry, and those in the government all sit down together to create the laws that are put into place. Obamacare was written in part by the insurance companies, and then you saw the premiums rising and rising, still to this day. Look at what people are finding themselves in today. Further burdened by everything that they have put in front of them. No matter what it is, whether it's financial aspects, no matter what, healthcare or anything else. There's more in here, but essentially what they're trying to do is repeal any little, very small restrictions that are on these financial companies that have ballooned up to create derivatives in the trillions and trillions, no matter where you look. And they want to be able to expand on that even further because their corporate profits are stretched. They wouldn't be making a big deal about it if they weren't worried about their corporate profits. But right now, maybe they're pushed to the edge and they need to get a little more breathing room. Well, Glass-Steagall. So before Dodd-Frank, we had Glass-Steagall. And it's important to clarify exactly what we talk about when we say Glass-Steagall. We need to put that in quotes. I'm going to read this to you because I know that it will clarify for a lot of people. We can still refer to Glass-Steagall in the future as this, but I wanted to just really solidify this, okay? First, let's be clear on what exactly we're talking about when we talk about the Glass-Steagall. There are confusingly two Glass-Steagall Acts. There was the Glass-Steagall Act of 1932, and check this out, which allowed the Fed to back its notes with government securities rather than gold and to loan out its gold. So if anyone's wondering when this whole loaning out of the gold came into effect, 1932. Basically, no one talks about that one anymore. Then there was the Banking Act of 1933, and jointly sponsored by Glass and Steagall. That bill was probably most notable for creating the FDIC, Federal Deposit Insurance Corporation, and the Federal Deposit Insurance System more broadly. It also regulated some forms of speculative activity by investors, all right? And what we're talking about here are these four sections. So it covers each section below. I'm not going to get into it, but right here, these are the sections of the law that regulated the relationship between investment banks like Goldman Sachs and commercial banks like Bank of America. So essentially what they said was, if you're a bank like Goldman Sachs, you can't also have, for example, some grandmother's bank account in the same company, okay? That's not going to happen. You can't do that. But something changed along the line, and of course that needed to happen because these companies were saying, look, it would be really good if we could open up a little speculative company. I know we got grandma's bank assets here, but don't worry about it. We have a good old 5% in our ratio, leveraged up only 95%. We'll do fine. We'll be fine. Don't worry about it. Nothing to see here. No problems. This time is different. So in these, basically that's what they talk about. Glass-Steagall, what they're referring to, specifically these four sections. I wanted to make that clear because it's referring to the Banking Act of 1933. That's just a fact. I saw it, wanted to bring it to you. I think it's important. So all of this now, these regulations put into place, and then 1999 comes around and they repeal it, allowing this to expand further and further. And of course, we saw what happened during the financial crisis. Absolute mayhem. Absolute mayhem. Well, what we can tell is that there is maximum collusion in the financial industry. And I believe that's actually more in the financial industry than any other industry, despite the fact that they are all completely corrupt. So looking at this here, the LIBOR scandal. There's an amazing infographic that I think everyone should check out, but I'll just cover a couple points from it. It's quite long. And I want you to see this. First of all, the LIBOR, I hope everybody remembers it, but I'll touch on some points in here. The benchmark for interest rates worldwide. LIBOR's influence in comparison. Total value of the securities and loans affected by LIBOR. $800 trillion. $800 trillion, and the world GDP about 70 trillion. Just think about that, all right? How LIBOR rates are set. You have your member banks, representatives of the member banks, and the LIBOR rate. You can see this here, the way that everything's moving. Now, that's how it's supposed to work, right? Look at the directions of the arrows. All right. Now, What actually happened? Well, you can see how, if I just draw some of these famous arrows, the banks did a little bit of communicating on their own. Kind of went around the system. So they were all supposed to go back in this direction, but that didn't happen. They essentially decided to discuss amongst themselves, okay? Very clearly at the bottom here. During the 2007 to 2009 financial crisis, banks wanted to appear healthy, so they communicated with each other and submitted lower than usual borrowing rates to be calculated. Similar to lying on your salary on the loan application, banks were lending money in the open market at lower interest rates and collecting less profit in return. Their clients, the investment vehicles, suffered by not getting their share of lending profits as they would be in a normal open market if it was not rigged. They were screwing everybody over. This right here was a time in which they were caught red-handed. What happened? Nothing. Nothing was done. Nothing was resolved. Don't go anywhere. Make sure you click on part 2. The link will be in the description below. I'm going to get into so much more information. See you there.